Welcome back. Today we will discuss the next topic which is important for your exams. Topic 2, income and assets. So what will be your taxable income and what will be not your taxable income? That is what we are going to discuss in this particular topic. Remember one thing, whatever income you earn, all the income is taxable. This is the general rule. It's taxable unless it is specifically exempted by IRC. IRC means Internal Revenue Code. Okay? So income is actually categorized into some categories. First is your salaries and wages. Second is your investment income. This includes your interest and dividend. Capital gains means gains while you are selling your capital asset. We'll discuss each and everything in detail, don't worry. Rental and royalty income. Retirement income. Retirement income means the income you receive from your 401k, etc. Other income. These are broad categories. There is another category, your business income. So what comes under business income? That and all we will discuss. Okay, so we are discussing income of an individual. In India, we'll be having heads of income, but in US there is no concept of heads of income. These are various categories of income. Okay. So before that, you should know some basic concepts. We'll discuss that now. All the income in US is divided into two types. One is your earned income. Another one is your unearned income. Earned income means income you earn by doing something, like your wages, business income, etc. So it is your active income. Unearned income means income you earn from passive assets, like your interest and dividend, capital gains, etc. So this is your passive income. Why this categorization is important, we'll discuss. Okay. So these are your income categories. These are your types of income. Now come to the first category of income, salaries and wages. In salaries and wages, your employer, if you have salary income, gives you some form called form W2. Basically we call this form as wage statement. So this particular form contains what is your taxable salary, what is your taxable wages, and what is not taxable. There is also another concept called FICA taxes. Okay, we'll come to salaries and wages again. Let me explain this concept, then we'll go again. Okay, FICA taxes means Federal Insurance Contribution Act taxes. So basically it covers two types of taxes. These taxes are over and above your income tax. One is your social security tax, another one is your Medicare taxes. Okay, these FICA taxes are collected by IRS and will be sent to Social Security Fund if it is collecting Social Security tax, Medicare Fund if it is collecting Medicare taxes. Social Security means your pension and all. Okay, so they administer your pension after you attain certain age. So these take care of your medical expenses after you retire. Okay, so these FICA taxes, remember FICA taxes are applicable only on end income. That is why the categorization of end income and unearned income is important, because FICA taxes are applicable only on end income. They are not applicable on unearned income. It means FICA taxes are available on your salary and your business income. For business income, we don't call it as FICA taxes, we call it as self-employment tax. We'll discuss. Okay, now let us discuss the rates. So if you are earning a salary, means you are employed somewhere. So Social Security tax and Medicare tax. You have to contribute 6.2% of your salary, of your adjusted gross income, as employee contribution. So this will be deducted from your salary, and your employer pays this amount to IRS. And again 6.2% is matched by your employer also. So you will contribute 6.2% and your employer also contributes another 6.2% extra to your Social Security tax, to your individual name. Medicare taxes, you will contribute 1.4% of your salary, and your employer contributes another 1.45%. So they will do the matching contribution. So total FICA taxes are approximately 15.3% of your adjusted gross income. Not adjusted gross income, your salary. where half of the contribution will be from your paycheck, so they will deduct from your salary, and half your employer will contribute. There is another thing called additional Medicare taxes. This is 0.9%. This is applicable for high income earners. So for whom it is applicable? High income. High income earners. So if you are single and you earn more than $200,000. So in India we call $2 lakh, but in US they call as $200,000. Then you will be treated as high income earner. If your status is married filing jointly, then if your income is more than $250,000, you will be treated as high income earner. Married filing separately, half of this, which is $125,000. So if you cross these limits, then you have to pay additional Medicare tax of 0.9%. And also remember one thing, FICA taxes are called payroll taxes, and these are applicable, this 6.2% social security, right? Tax is applicable up to a age limit of $176,100. It means, suppose let's say your income is $1,80,000, $180,000. Then up to 176,100 into 6.2% you will pay social security tax. And remaining $3,900, there is no need to pay social security tax of 6.2% from employee and also employer. So this is the wage limit. And also remember, there is no wage limit for Medicare taxes. So you have to pay 1.45% into 180,000 US dollars, your Medicare tax. So these are the limits and these are the FICA taxes, basically called payroll taxes. I told you this social security tax and Medicare tax are also applicable on all the earned income, right? So next earned income is your business income. For individual, business income will be your self-employment income, your partnership share, and also in S corporation, shareholders receive distribution of to income. So that also you will treat as business income for individual. All this is called as self-employment income as per US IRC. Okay. So now you have to pay self-employment tax on the self-employment income. Self-employment tax is basically your social security tax and Medicare tax. Okay, so the total is 15.3%, where in case of employment your employer contributes half. But here in self-employment what happens is both the portion, employee portion and employer, because there is no employer. you have to pay, which is basically 15.3%. 12.4% is your social security tax and 2.9% is your Medicare taxes. So 15.3% is you have to pay your self-employment tax. Remember one thing, this self-employment tax you have to calculate on this 15.3%, right, is calculated on so what you will do is 100, you will reduce your 6.2 and you will reduce your 1.45. So what is this 100 minus 7.65, so 92.35%. On 92.35% you have to pay 15.3%. 92.35 into your self-employment income. So you won't take 100% of your self-employment income, you take only 92.35% of your self-employment income. On that amount you have to take 15.3% as self-employment tax. Why? Because in normal, if you are a wage employee, the employer contribution is not included in your wages. So if you are an employee, I have shown you, right? If you are an employee, okay, here 6.2 is calculated on your wages and this 6.2% is not added to the wages. Okay, and 1.4% is calculated on your wages. This employer share is not added to your wages. So to remove that inconsistencies, if you are a self-employed person, should not take 100% of your self-employment income. You have to take only 92.35% into your self-employment income. On that amount, you will pay 15.3% as your self-employment tax. So this is about your Social Security and Medicare taxes. It is collected by IRS. It is extra of your income tax. Okay. So now we'll see some more concepts before going into the salaries and wages. The first concept is doctrine of constructive receipt of income. It means, I'll take one example. Let's say your employer has deposited your salary on 31st December 2025, but you didn't go to the bank and you withdrawn this salary on 4th January 2026. So as per this constructive receipt of income, you should include this salary in 2025 tax year, not your 2026 tax year, even though you have physically received in 2026 tax year, but it is made available to you in the 2025 tax year only. Whether you withdraw it or doesn't withdraw it, it is not IRS bother. So it is your responsibility to withdraw. You didn't withdraw. So why IRS has to postpone the tax on this particular salary? So that is what your doctrine of constructive receipt of income says. So I hope you understood this concept. So if you receive any income which doesn't have any restrictions by law, so sometimes it happens that court may award damages but only by fulfilling certain conditions. So there is a restriction on that particular award, which is your income. If you satisfy those conditions only, you are rightfully eligible to receive that income. In that case, you will be treated, you will be not taking that income as your income in the year where it is made available, but which you don't have any constructive receipt. I hope you understood this concept, doctrine of constructive receipt of income. Next is now coming to our salaries and wages concept. Okay, so all taxability of salaries and wages. Okay, we'll see which is taxable and which is not taxable. Your salary, what you receive from your employer, advance salary, garnished salary, everything is taxable. What is garnished salary? I'll give an example. Let's say you didn't pay any, you are liable to pay child support. Child support means normally what happens, no? In US, if you are divorced, the court may order that you have to support your child, which is with your divorced spouse. So let's say you are a husband and your wife doesn't have any income and you got divorced and there is one kid. The kid stays with your wife, but as per the court order, you have to pay the child support. Court may order in such a way that the child support may directly deducted from your salary and paid directly to your spouse. It may order your employer to do that. Okay, so we have seen this doctrine of constructive receipt of income, no? And you can't tell to the IRS that this salary is not at all received in your bank account. That's why I won't offer it. That doesn't work. Okay, so this is your legal obligation. For legal obligation, they're deducting from your paycheck and paying. So you should treat this as your income at any cost. That is the garnished salary. Okay, now we'll see what are the non-taxable salary elements. One by one we'll discuss. First is your life insurance premium. Up to cover of $50,000. If your employer is paying the life insurance premium on your behalf up to the cover of $50,000, then that particular benefit or prerequisite. So we call in US as fringe benefits. This benefit is non-taxable, even though he is giving you a benefit. Okay, which is not in cash, non-cash, which is in kind. This is one of the non-taxable element. Second one, de minimis benefits. Suppose let us say your employer is offering some snacks, some tea, coffee, okay, which the value is very minimal. We call them as de minimis benefits. These are also not taxable. Okay, now third one, transportation benefits. If your employer is providing transportation benefit from your household to the office, that's it, then it is non-taxable. And there are many other non-taxable items, etc. you can say. This is about your salary. Now coming to the next category, which is your business income. So basically business income means your self-employment income. Remember, if you have self-employment income of $400 or more, then you have to compulsory file your return. Okay, so if you are doing job and you are doing some side gigs income is also treated as self-employment income. If your job doesn't have income till, okay, so 15,750 I told you, for single status. So let's say your salary is only $10,000 and you have done some side gigs where your self-employment income is $1,000. Even though it is not exceeding your 15,750 US dollars limit, as your self-employment income is more than $400, you have to compulsory file your return. So that is what it means. And also, if you have self-employment income from any one person, okay, let's say you perform some task, some contract job for some company where they have to pay you $600 or more, then they will give you some form called Form 1099, reporting your self-employment income. Okay? So for your self-employment income, you have to pay self-employment taxes, which we had discussed before, and also you should include in your taxable income in your Form 1040. Now coming to another category, your partnership share, where they report in Schedule K, that also will be treated as your self-employment income. So how it is calculated, no? Self-employment income. So self-employment income is calculated like this: your turnover, so whatever jobs you do, your gross income from your jobs, less your business expenses, the balance profit and loss from the business will be your self-employment income. So you will make profit and loss, and whatever profit you are getting, that will be treated as your self-employment income. So you are paying self-employment tax, right? You can take 50% of self-employment tax as a deduction. Remember that this will come in your exams. So I hope you understood about this business income. We'll go for the next category. Let us see our material now. So this is your income and assets, taxable income, wages and salary. So we discussed about this concept, earned income and unearned income. Okay, this category encompasses all taxable income received for services performed, like your wages, salary, professional fees, etc. Earned income is generally subject to your social security and Medicaid taxes. That is what I have told here. Unearned income. Unearned income is income from investments and other non-work sources, like your capital gains, interest, dividends, etc. They are not subjected to FICA taxes. Now we have discussed this concept, doctrine of constructive shift of income. It applies to cash basis taxpayers to report income in tax year which it becomes available to them without any substantial limitations or restrictions. Example, income is considered, for example, you can see here example, a check placed in landlord lockbox on 30th December is taxable in that year even if the landlord does pick it until January. So without any limitations or restrictions, if someone is receiving the income, then you should treat that particular income in the tax year only, not in the year where it is physically available. Okay. These are FICA taxes, your payroll taxes. So FICA abbreviation is the Federal Insurance Contribution Net Tax, which is your Social Security tax and Medicaid tax. So these are the rates for 2025. 6.2 is for employee contribution, 6.2 is for employer contribution. Total is 12.4. Medicaid tax rate is 1.45 plus 1.45. So combined rate 7.65 into 2, which is 15.3. So additional Medicare also we have discussed 0.9%, and this is available for these limits. Okay. Now for self-employed taxpayer, which is your business income, you can see this limit also, basically your wage limit 176 100. This is also discussed. Now coming to your self-employed taxpayers, the filing threshold is $400 or more. You will receive 1099 for $600 or more. So these are your types of self-employment income. I told you the self-employment tax rate. So this is the self-employment tax, 15.3%. It is applied to 92.35% of self-employment earnings, not your 100%. And the same limits apply here to 200,000 and 250,000. And this is also discussed, 50% of self-employment tax can be deducted. Now coming to the employee compensation, your wages will be your taxable income. Advanced wages and garnished wages. Garnished wages is already explained. If you want, you can take the example. If your employee wages are garnished for debts like child support or back taxes, the full gross amount must be included in the taxable income, not the half amount. Okay. Tip income is important. A recent amendment came where you can actually deduct qualified tips up to $25,000. So I told you the non-taxable income, life insurance cover, the value of employer provider coverage. If it doesn't exceed 50,000, it is non-taxable. If it exceeds 50,000, that portion is taxable. And these transportation benefits also discussed. Cafeteria fans and flexible spending arrangements. You can see here de minimis benefits, because most of the MCQs are coming from this de minimis benefits. Small items such as coffee, snacks and occasional personal use of photocopier are excluded because accounting for them is impractical. Only small expenses are non-taxable. So that is about your employees, salaries and wages. Everything is explained. I hope you understood. Thank you. And there are also some other incomes which are taxable, like your interest income, dividend income, qualified dividends, etc. etc. Thank you.